Welcome to RichTrybe. Today, we're looking at real estate investing a little differently. We're diving into the BRRRR method. And listen, this isn't just about buying houses. It's about building a well-oiled business machine. You put your raw materials in one end, and long-term wealth comes out the other.
There's this fantastic quote from financial expert Mel Abraham that hits the nail on the head. He says, "You want to build a business machine designed to generate income that's no longer tied to your work or efforts." Think about that for a second. By setting up a reliable, repeatable system, you're creating a machine that generates passive income without your constant daily grind. You build it once, and it just keeps working for you.
Okay, building a wealth machine sounds absolutely amazing in theory. But practically speaking, what exactly does this acronym even stand for? Because honestly, to a beginner, this sounds a whole lot like we're just flipping houses. How is this actually any different from buying a fixer-upper, making it look pretty, and just selling it to the highest bidder?
That's a super common misconception. But unlike flipping, where you sell immediately for a quick one-time profit, the BRRRR method is all about holding on to the asset. It breaks down into 5 very distinct phases: buy, rehab, rent, refinance, and repeat. You're holding the property for long-term appreciation and cash flow, rather than just cashing out and getting hit with massive capital gains taxes.
So let's start at the beginning. Phase 1. Buy. This phase is all about finding a property with hidden potential at a serious discount. You're hunting for that sweet spot. You want a property in disrepair, sure, but it absolutely must be in a great neighborhood where its value can just skyrocket once it's fixed up. We're talking distressed properties, maybe pre-foreclosures, bank-owned homes, or just places that have been totally neglected. Imagine finding a $100,000 absolute eyesore sitting right in the middle of a street where every other home is selling for $250,000. That is exactly what you're looking for.
Wait a second, though. If I'm specifically targeting a distressed property, aren't I going to drain all my cash just trying to make the place livable? Isn't the rehab phase incredibly risky and expensive for someone just starting out? I mean, we've all seen those home renovation shows where everything completely blows past the budget.
Phase 2, rehab. And hey, that's a totally valid concern, which is exactly why this phase requires incredibly strict financial discipline.
Remember, you are repairing a business asset here, not building your personal dream home. You've got to maximize your return on investment. It's all about calculating which specific repairs give you the biggest bang for your buck to boost that overall appraisal value. Like spending 10 grand to add a second bathroom might bump the home's total value up by 30 grand. That completely changes the comparable properties an appraiser is going to look at.
Now moving right along to phases 3 and 4, rent and refinance. Once the dust settles from the renovation, your investment shifts from a money pit into an income-producing asset. First up is the rent phase. Now, this involves the very real responsibilities of being a landlord. You've got to secure reliable tenants, sign a rock-solid lease, and pull in enough monthly rent to comfortably cover your eventual mortgage, taxes, insurance, and still leave you with a positive cash flow. Say your expenses are $1,200, but you're collecting $1,600 in rent, that $400 spread, that's the fuel keeping your machine running. Okay, but here's where my anxiety kind of kicks in. The 4th step is refinance. I'm really worried about the bank's appraisal. What if the market shifts, or the appraiser just completely disagrees with my valuation and the property doesn't appraise for enough? What if I literally can't pull my initial investment back out? You're right, the appraisal is absolutely a risk. But here's the difference. In traditional real estate investing, you have to scrounge up a brand new 20% down payment for every single property you buy. With the BRRRR method, you take out a new loan based on the new, much higher value of the rehabbed home. If it works out, you pull your original cash back out, tax-free, and it's ready to be reused. You entirely skip that traditional trap of needing fresh savings every time you want to buy a house.
Which brings us to phase 5, repeat.
Getting that cash back is where the true wealth-building magic actually happens. The crucial point here is taking that tax-free cash out from property number 1 and using it to fund the down payment and rehab for property number 2. Then you do it all over again for property number 3. As detailed in Brandon Turner's famous guides on this strategy, you're repeating this cycle to build a massive portfolio of cash-flowing properties, all while leaving minimal, if any, of your own original capital stuck in a single deal.
Okay, I'm following the logic here, but man, this really sounds like an infinite money loop. If it's truly this simple to build a real estate empire using the exact same initial pot of cash over and over again, why isn't literally everyone doing it? There has to be a catch.
You are absolutely right to be skeptical, because honestly, it isn't easy. Before we dive into the very real risks that can catch investors off guard and ruin their portfolios, please subscribe to RichTrybe channel, like, comment, and share. It really helps us keep bringing you these deep dives.
Okay, let's talk risks and final takeaways.
We need to be completely realistic about the pitfalls and the massive commitment required to actually pull this off. Here's the reality. First, it requires a serious amount of upfront capital just to secure that first property and pay your contractors way before the bank ever reimburses you. Second, estimating property values is incredibly tough. The speculation risk is huge if the housing market dips or values just don't appreciate the way you planned. Plus, finding properties with enough of a financial spread is really difficult in a competitive market. And don't forget, being a landlord takes a ton of your time, your energy, and frankly, your patience.
So, the question remains, are you ready to start building your own real estate money machine? Or is the upfront capital and time commitment just a bit too high for you right now? Let us know what you think. And remember, in the next video, we'd be talking about how can I apply the BRRRR method in real estate. See you then.